This method or this exercise is the one dealing with the direct write-off method, which again is the one that most likely would not provide you or give you proper matching on the income statement between revenues, fees earned, and expenses within the same year. This is the method that companies use sometimes because of how simple it is. But again, this is the one that most likely companies that use this method do not have a large amount of bad debt or customers on account that default. Okay, so make sure you know all that for questions dealing with true false questions, multiple choice. By the way, this method is the one that does not have, we do not use an allowance account. This method is the one that we don't do an adjusting entry at the end of every year to record bad debt. This method does not provide you with information to the net realizable value of receivables. Okay, so in all those could be questions on the final exam. So with this method, all we do is so simple because all we do is when we identify the customer that we provided services to on account and he's not paying us and we've decided that now it's pretty, we're almost 100% sure that he went bankrupt or that he's not going to pay us back. At that point, we record the bad debt expense. So what that means is that during the year, you're going to be recording bad debt expense on a regular basis. Every time a customer defaults, you debit bad debt expense. So you will be affecting the income statement every single time that you write off a bad, a customer on account that defaults. Where with the allowance method, the one that I'm going to do in the next few minutes, we don't record bad debt expense every time a customer defaults, but instead we do it once a year at the end of the year. Okay, so again, that was just a summary. But anyway, what are they asking us to do? It says that on March 17th, we have a customer Ian that did not pay and is not planning to pay 1980. The reason why I'm doing this with you together is because Cengage does not give you two separate entries. I did it here on the right, so you can see that I'm doing a journal where it's easier for you to see that this is what actually happens. We're going to record bad debt expense for the amount that is not going to be collected. I see here says that you wrote off the remainder owed of 3,090. So let me do this one first, okay? So we're gonna debit the expense 3,090 and we're going to remove the receivable 3,090, and this is what we call the write-off entry using the direct method. And then here I'm going to debit cash for the amount that we did get, which was 1,980, and I'm going to credit account receivable for 1,980. So again, these two entries are the same as this one that I'm going to do right here, which is like a compound, just one entry together. So I'm gonna pretty much do the same thing. So bad debt expense and cash need to get a debit. So here I'm going to start with cash, and I'm going to debit cash 1980 right here. Cash 1980, cash 1980. Then I'm going to debit bad debt expense for bad. Let me look for bad debt expense for the amount that we're not collecting, the amount that Ian is not paying. And then I'm going to credit again account receivable and account receivable. So I'm going to credit account receivable, and I'm going to plug in here the total amount, which is I believe it's 5,070. Okay, very good. Okay, so by the way, for the exam and quizzes, this right here is what you need. Okay, so for instance, they're going to ask you a question like this. I'm going to tell you when using the direct method, bad debt expense will have a debit of 3,090. Yes or no? Or when you write off, when you receive 1980, you're going to debit cash and credit accounts receivable. Correct. Okay. But anyway, for homework, they ask you to do. They basically telling you that Ian, the amount that you had written off, somehow Ian pays you back. So here we need to like it's called reinstate, reverse, put it back on the receivable. So what we're going to do is we're going to debit account receivable. Again, when I put this 3090 back to the receivable, 3090, and we're going to remove the bad debt expense because it's almost like we did not incur a bad debt expense because Ian finally paid. Okay, so basically I'm reversing this entry, putting it back as a debit to account receivable and credit bad debt expense. But that only basically fixes the problem of getting rid of the expense and putting it back to the receivable. We still have to do the collection of cash because he did pay. So we finally increase cash 3090 and we credit account receivable 3090. Now if we were to look at the general ledger, the account receivable, you will see that the account receivable at the end of all those transactions for Ian is 0 because Ian got a debit when we earned the revenue on account. Then Ian account receivable got a credit when we wrote off the account. Then Ian got a debit when we realized that he did pay, and then Ian got a credit account receivable when we finally collected the cash. So it's a debit, credit, debit, credit. So the account receivable will have a debit for 3090, a credit for 3090, a debit for 3090, and then a credit for 3090. So at the end, the account receivable for Ian has 0. Okay, the bad debt expense also has a 0 amount because here you debited the bad debt expense 3090 and here you credited. So the bad debt expense will also have a 0 for Ian. Okay, so at the end you end up with cash and fees earned. If you have any questions, please let me know, and then in the next couple of minutes I will try to do another one similar to this but using the allowance method.